This is Savajit Chatterjee recording our weekly session of Chartsarefun. This is for the week of June 30th, recording this on July 6th, this Sunday afternoon. Well, last week was a holiday shortened week, but the market continues to climb higher highs. We know that it was a big week with respect to the big, beautiful bill passing. It passed both the Senate and the Congress on Thursday before the holiday shortened market closed at 1 p.m. It passed the House right after that, after it closed at 1 p.m., and then President Trump signed it on July 4th. Well, we know that market was closed on July 4th. That was a holiday on Friday, but the Bitcoin does trade 24/7. We'll see how Bitcoin reacted to the notion of buy the rumor, sell the news. So there was quite a big anticipation about this big, beautiful bill passing. It did finally pass, but there have been some trends. There have been some signals to watch on the Treasury market. We had previously talked about the 1-month Treasuries. We'll look at that. 1-month Treasury often indicates where the interest rate cuts are going to be coming with respect to FOMC. There's a meeting coming up late July on FOMC and the 29th and 30th. So we'll see what the 1-month Treasury market is predicting with respect to the rate cut. And then we also know that last week we had the jobs data. ADP was weak. The economy lost jobs. And then turned out that the non-farm payrolls was strong, higher than what was expected, and the unemployment rate came down to 4.1%. So those two combined kind of took the market a little by surprise. We'll see what the 10-year yield did. That's the long-term yield. We'll see what the Treasury market is telling us with respect to US. There is expectation from the big, beautiful bill to add to the debt. The US debt is now over 37 trillion. There has been Congressional Budget Office predicting almost as 3 trillion extra amount of debt added to the US Treasury over the next several years. So we'll see what the Treasury market's indications are on this bill passing with respect, at least on Thursday, when because it reacted both to the unemployment non-farm payroll data and also to the fact that there was quite a bit strong expectations the Congress would pass the bill. And we will look at some of the indicators, in particular VIX, which is the volatility indicator. We look at that. We look at breadth indicator called the New York Stock Exchange Summation Index. We'll also look at some of the risk-on plays, whether it's Bitcoin, Palantir, and NVDA. Those three have been strong risk-on kind of risk-on play instruments that we look at what they're saying, and an interest rate sensitive ETF, the Russell 2000 ETF IWM. And then we will end the analysis with the S&P 500 and the NASDAQ 100 ETF QQQ, two big barometers of the market. So let's get right into our blog site called chartsarefun.substack.com. The last blog was on July 5th, Weekend Chart Patterns. We do publish this every Saturday. We appreciate you subscribing to this blog site. Just share your email and the blogs will be sent to you as soon as they're published. Our YouTube site is also Chartsarefun. YouTube.com/Chartsarefun is our channel. Appreciate you subscribing to our channel. If you do like our videos, appreciate you hitting the like button. That really helps us create and get more engagement on these videos. So we said we will start about what the Treasury market, often called the smarter money indicator. And this is the 1-month Treasury, UST1M for 1 month. And we know that in the past, whenever there has been rate cuts, ahead of the rate cuts, the Treasury market has indicated the rate cuts. In particular, the first 50 basis point rate cut came on September 18th, and look at a couple of weeks before that, from late August, a waterfall decline of the 50 basis points had already happened before the actual rate cut came. So that's in the late August, we saw that the Treasury market, the 1-month Treasury was at around the 5.4%, came all the way down towards the 4.7%. So there, it actually overstepped in terms of the movement. Instead of 50 basis point, it almost went 70 basis points. But by the time the rate cut did come in, it settled down around closer towards the 4.8 or so. So then we got the next rate cut right after the election on November, after the election on November 4th. And there again, late October, we can see that the 1-month Treasury started correcting, the yield started falling, anticipation of the 25 basis point cut. And that's what we got. So 4.55 to 4.8, that's how much it fell, indicating the 25 basis point cut ahead of the cut coming in. And then into December. December 18th was the last 25 basis point cut. And then we noticed that there again, From somewhere around 4.65, it fell towards the 4.3. That's a little about 35 basis points, but we only got a 25 basis point cut. But that's since then, we've got a steady flat line on the 1-month Treasury in the region of 4.3 to 4.4. That's where it's been hovering till very recently in early June. And that's where we can see that the 1-month Treasury market on 4.3 fell towards 4.07. That's 23 basis point, very close to the 25 basis point cut expected in the next FOMC decision. Well, till late June, the expectation was that they would perhaps get that 25 basis point cut in July, till the point when the job market and overall Powell's indications out there. He had Senate hearings, he had a press conference, in the June meeting and so on. He's been extremely hawkish. He's been extremely concerned about the tariffs. And we know that the July 9th, that's the next big event. So we'll see in anticipation of the July 9th, which is when the 90-day pause on the tariffs will get lifted. There's already letters that have gone out end of last week to all the countries asking them to negotiate and get to their better rates. Otherwise, if you remember, those reciprocal tariff rates from the early April was significantly higher. That's the Liberation Day tariffs. And the 90-day pause was put in place on April 9th, but on April 2nd, when the Liberation Day tariffs were put in place, many of those were 50%, even to 100% kind of rates. The only country so far that has settled on the rates is the United Kingdom, Vietnam. Vietnam deal happened last week. There is quite a bit of tension with Japan. There has been in the news that some kind of trade tensions going on with Japan about their negotiated rates. We know that the Eurozone is still kind of got an extension, but they're also hanging in there, have not made a deal yet on the rates. So next week could be a volatile event or volatile week with respect to what's expected from the tariffs front. And that's what Chair Powell is waiting on. He's given clear indications that until he's sure that the tariffs are not going to cause inflationary concerns, and there's a lot of uncertainty on where the tariffs will land, he's unwilling to make a decision on rate cuts. He knows that the labor market is weakening. He's seen indications of that. But then, the non-farm payroll data keeps printing stronger numbers, at least an unemployment rate from 4.2 coming down to 4.1. And then the addition of close to 200,000 jobs for the month of June are all strong indicators where he does not got any rush to go cut rates, is what his thinking are. And what we see here is, while there was an expectation from the 1-month smart money Treasury from 4.3 coming to 4.07, that's 23 basis point, which is typically a 25 basis point cut. That has since then reverted back to 4.26, closing near 4.23. So there is really not as much of a rate cut expectation in the market right now, looking at the 1-month Treasury. The 10-year yield, however, had a bullish kind of, if this was a yield, but if this was a stock, this kind of a wedge pattern, falling wedge as it's called, where you have the highs, lower highs, and then if you draw in the lows, if you draw that, it's kind of a narrowing wedge, and from there it broke higher, the yield broke higher. The last couple of days on Wednesday and Thursday, the yield started reverting. And typically when you have a falling wedge, the reversion back takes it from where the wedge started, around 4.5%. So we're expecting 10-year yield kind of testing a key support level at 4.2 to climb back to 4.5. Maybe it settles down at 4.5, consolidates for a bit, and then breaks higher. So 4.2 to 4.5 is 30 basis points. Add that to 4.5 takes us back to that 4.8 key level from early December. And that, if it breaks, you're talking at a significantly higher 10-year yield. So 3.6 is the low on September to 4.8. That's 120 basis point. If we get a breakout above the 4.8, that would be a key resistance level for the 10-year yield to break. That 120 basis point added to 4.8 takes us to 6.0%. That's not going to be taken well by the market. If that does happen, expect small caps, expect the rate sensitive sectors to take a beating, and expect some form of a correction to shape up in the market. So that's something we are watching. Key reading of tea leaves is from the smart money in the 10-year Treasury. It did break out from a falling wedge on last week, Wednesday, Thursday. It is now around the 4.35%. We'll see if it can climb up to 4.5, break higher to 4.8, and eventually break 4.8. That would mean a rocky summer if the breaker about 4.8 comes in. And this could come in from market's expectations of U.S. debt. As much as the big beautiful bill passed, there's going to be significant amount of budget deficits, and there's been Elon Musk and Ray Dalio and others who have raised warning on U.S. having to kind of get all this debt reimbursed. They have to effectively issue short-term treasuries to basically fund the deficit spending, and all of that impacts the market's expectations of U.S. rates. So that's the key. We're going to watch what happens in the 10-year yield as a leading indicator to where we think the market could. Now, looking at a fear gauge called the Volatility VIX index, which is really measured by the total puts and calls that are out there in the S&P 500, and that we can see lower lows in the VIX level from 17 to 16.23 to 16.11, but positive divergence in RSI and MACD. That indicates that potentially VIX could be bottoming and we could get a higher high, kind of a move higher in VIX. Not a higher high because that 60 was a trade tariff spike. I doubt we're going to get back to 60, but potentially a move back towards the 28 cannot be ruled out. We can see from the 14th to the 28 having tested twice in December and then into early March, and hence a move from here at this 15, 16, high 15 to the 16 to the 28 is definitely a possibility in the VIX. And if that happens, expect a market pullback. Now, one indicator that the bulls would point to is market breadth. That's the New York Submission Index. Typically, trades in the minus 1100 to the plus 1100 level. We saw that in 2022 October low, it had hit minus 1100. That was extremely oversold levels in the span of 6 months. By February, March had gone up to the plus 1100. And then from there, it touched minus 834, a higher low at minus 590 recently in the April bottom, and now has been climbing for the last several weeks. Bit of a shallow pullback after having climbed from minus 590 towards the 700 level, pull back towards the 500, and since then it's broken up to 806. This is catching momentum, can easily climb back to the 1100 level. That's the upper end of the summation index. This indicates market breadth. The McClellan Summation Index from the New York Stock Exchange, the 3,000 plus stocks, it looks at overall what's the market breadth in terms of advancers and decliners. It's a cumulative summation index, and hence it tends to kind of move in, not in like quick spikes. It tends to move in more of monotonic climbs and then monotonic declines. So we had the pullback from 1112 to 590, minus 590. Since then, a rise is climbing up. Expect this to retouch because it's already tested since that October 2022 low 1100 thrice in the 2023 February timeframe, in the late December of 23 timeframe, and then in the late September, early October of 24. We could expect every few months, we can see here, separated out 6 to 9 months, we do get a test of that 1100 level. So we tested last towards October, late September, October. So for there, talking about almost 8 months have happened, and it's another month, 9 in the July timeframe. Wouldn't be surprised if the 1100 gets tested, so which means summation index climbing means there's an overall market breadth improving, overall market going higher. Now let's look at some of the key risk on indicators. The biggest one is Bitcoin. This trades 24/7. This is a beautiful cup from 109,000 top that it saw in January towards the bottom of the cup at 74.4 in early April in the market bottom. Came up to a higher high from the 109 at 112. So that cup then formed a shallow pullback from 112 towards the 98 along a declining channel, which is beautiful handle. And last week, it broke above that channel. If you took the lower lows from 112, 110 to 109, it broke up and retested that 110 level last week. And then 110, it has since then shallow pullback. If you look at each of these candles, these are daily candles. And that red candle that we saw was on the July 4th when President Trump signed his big, beautiful bill into action. When he signed that, that was a sell the news. We saw a pullback in the Bitcoin to retest that top channel trend line from below, from above. It came down to test it, and then it has rebounded the last couple of days on Saturday and today on Sunday so far. It is reclaiming or climbing back. If this breaks from 98 to 110, that we are talking about as a 12,000 depth of a cup. So a cup from 110.5 to 98.3 to 110.6. That's a 12,300 depth of a cup. Added to the 110,600 to 12,300. You're talking about 122,900, so almost 123,000. That's the cup and handle on this Bitcoin. So that's something we got to watch. If that upside is there, it would mean upside for the S&P and QQQ, because this is a risk-on instrument. And if this does turn out to be a breakout and continues higher high with momentum, then we could expect S&P and QQQ to climb further. And I'll talk about some targets from the S&P and QQQ charts to see how far higher could they be climbing. Now, another risk-on trade is Palantir. This is call it the leading AI stock, AI software stock, heavily used by the US government in warfare, in a lot of the, defense strategic planning and kind of tactical software decision making. Also used by many, many hospitals and many, many other Fortune 500 companies for AI-driven monetization. They have amazing technology for taking, call it the insights out of the data. They map the data into a semantic layer, and from there they use AI to power executive decision making, help driving AI edge for companies. One of the leading monetization software companies in AI. And that's got a beautiful cup from 125.4 to 66 to 125.25. So that measured cup is $59. 66 to 125 is $59. At 59 to 125, that gives you 184. So this cup from 125 to 66 to 125 from that breakout measures to 184. Did Palantir quite get to 184? No, it got to 148.2. Since then, it's pulled back to test that 130 level recently, as of last week. Now, this is a daily chart. Every candle is a day, but what is to be watched out here is this negative divergence in RSI. Over the last 5 months, from February to say July now, we can see RSI is not printing higher highs. RSI is printing lower highs. That's negative divergence. Same thing with MACD. MACD is printing lower highs. Accumulation distribution did climb, but most recently it has been flattening and trending lower. We can see in the last week of June, AD came lower from where it was, and so did relative performance to S&P 500. This is PLTR to S&P 500 with the ratio sign, relative performance, declining in the last couple of weeks. So this indicates that while maybe we may get one more exhaustion move towards that 184 target. So as I said, 66 to 125 is 59. At 59 to 125 is 184. But from that 184, we'd be very cautious on Palantir, kind of hitting a top and having a deeper pullback, especially looking at the negative divergence in RSI, negative divergence in MACD, and more recently, accumulation distribution, relative performance, kind of losing momentum and forming lower highs. So that's something we need to watch out on Palantir. I know that there are a lot of Palantir bulls, but watch out. If there is some upside, yes, up to 184. Beyond that, I know Jim Cramer and others, Dan Ives have talked about 200 Palantir target. It might overshoot 184 and get there, but I would be very careful on the negative divergence setting up on its chart. Another story stock is NVDA. This has a beautiful, just like Palantir, a beautiful cup and handle, 143.4, 86 up to 143. So 86 to 143, you're talking about $57 of the depth of the cup. At the 57 to 143, that's 200. So that's where we think NVIDIA is headed. It has since broken up the previous highs at 153, testing 160.98 on Thursday. It is climbing higher highs and potentially could go up to 200, but near term, look at the RSI. As it printed a higher high in price, RSI is at a lower high. Look at MACD, is kind of, just about, the histogram is just about the center zero line. It's at a kind of not taken out and started climbing to higher highs yet on the MACD. So far, we got to be watching out on NVIDIA for a near-term pullback. Not saying that NVIDIA tops out here. I still think there's a very good chance NVIDIA reaches its 200 target. This 200 target, again, is from 143 to 86. That's $57 of the depth of the cup. Add 57 to 143, you get 200. So 200 is definitely in the cards for NVIDIA later this summer into later this year. But near term, this negative divergence where we got a higher high in price. Also, look at the couple of candles. The candle that we see here on Friday, on Thursday, that was the last day of trading last week. This is a shooting star candle. You can see that a higher wick on the top and then a short body towards the bottom with very little of a wick on the bottom. That's kind of a shooting star. That's a bearish reversal candle. And then just 3 days before that, you see that other candle here, that's a hanging man candle with a long wick on the bottom and a short body on the top. So a hanging man candle followed with, in a couple of days later, with a shooting star candle are both reversal candles with a lower high in RSI. Potentially, NVIDIA could be indicating getting ready perhaps for a pullback. Maybe, if we join these 153 to that higher high, maybe a shallow pullback towards the 188, or for that matter, the rising 50-day moving average in blue towards the 134 is all that we get. And then from there, reversal higher towards the 200 target. But if we do get that pullback, it would be an excellent buying opportunity in NVIDIA in that 50-day test at, initially we'll be testing the 20-day at 149, and then that's in red, and then the 50-day in blue near the 134 is where potentially we could get a nice entry on NVIDIA. Small caps, let's look at the hourly chart, 60 minutes here. It had ascending triangle pattern, a base at 209, 199 with higher lows. That ascending triangle from 199 to 209 is $10. Add that to 209, that's 219. It did exceed the 219. As it kept climbing, it then formed a beautiful cup and handle from 215 down to 206 up to 214. So 206 to 214 is $8, and 81 to 93 is 12 cents. So $8.12 added to 214.93. That gets us to $223.05. It did exceed that. It hit 223.33 on Thursday. So we'll see. Right now, the IWM, which is the Russell 2000 Small Cap ETF, shows an overbought RSI at 77. We can see that the MACD has climbed higher highs. Accumulation distribution has been absolutely climbing since the last couple of days in July. Very sharp climb. Overall, it's an overbought where, having met its hourly cup and handle, perhaps it gets a pullback towards that 215 level. We can see that the hourly charts 50 a period moving average is at 216. That we know of 215, 216 was previously key resistance, will now be support. So we wouldn't be surprised to see a small cap pullback over the next, depending on the July 9th tariff resolutions. If we do get slapped back higher tariffs in some of the key countries, we could see volatility in the market, and this could indicate small caps pulling back towards the 215, 216. S&P 500, this is something we've shared in last week's video. Potentially, we were expecting an inverse head and shoulder. The joining the line across the previous highs, 6,099 in December to 6,128 in January to 6,147 in February. If we join that, it was somewhere around the 6,200. It did overshoot that. We got a gap higher on Thursday after the non-farm payroll and then the continued expectation of the big beautiful bill passing, and it closed at the highs. 62.79 was where it closed. So that is bullish. The fact that it gapped higher and closed at the highs, and the fact that it broke above this trend line of the rising highs, but this could be a fake out. This may not continue, and if they do get the pullback to form the right shoulder, we can see, by the way, a death cross in late April, but that turned out to be an invalidation because right when the death cross happened, the market bottomed. Now we're getting a golden cross. Could this be timing with the market near-term top? Just like a death cross timed to the bottom, with the golden cross here forming a near-term top, and then a potential right shoulder pullback towards that golden cross of the 50 going above the 200 around the 5,800 level. We can see 5887 is the 50-day climbing and 5842 is the 200-day climbing. So 5,900 is where the 250-day is, a potential pullback to form a shallow pullback to get a right shoulder and then a breakout higher. That breakout, if it does come, measures a lot higher over 7,600. From 48 to 62, you're talking about close to 1,400 points. Add 1,400 to 62, 7,600. That's the upside target if you do get this inverse head and shoulder pan out. That said, if you look at the S&P 500 from 56.95, waterfall decline to 48.35, back to 5,700. This is a beautiful ascending triangle. The resistance level is at 5,700. The higher lows from 48.35 climbing along kind of a sharply sloped line as how the ascending triangle forms. That ascending triangle breakout is from 5,700 to 48.35. You're talking about roughly 865 points. 865 from 48.35 to 57. Add 865 to 5,700 gives you 65, a beautiful number, 65 twice, but that's potentially where the S&P 500 could go. So we could potentially not get this right shoulder pullback as we were thinking. If the bullish momentum continues, we're already at 62.79. 65 is less than 300 points away. We could perhaps get another 4 to 4.5% climb towards the 65 level before the pullback really comes. So that's what the bulls are going to expect. They're going to expect RSI to continue show strength and higher highs for the price level of S&P to climb up to that target. That's the ascending triangle. A very similar pattern on QQQ. That's the NASDAQ 100. We can see that if you join the highs of the December and then onto February, it broke above that. It broke above that and has continued its climb towards the 557 level. If you would expect a pullback here on a shallow pullback, then that right shoulder pullback to test its rising 50-day at 515, its rising 200 days 501. So pullback towards the 501 to the 515 level to form a right shoulder and then break higher. Just like in the S&P's inverse head and shoulder, a right shoulder pullback can't be ruled out. Here also we see a golden cross of the 50 going above the 200, and that's a possibility. Now, if momentum is there, and it also has a beautiful ascending triangle pattern with 490 to 401. 401 to 490, you're talking about roughly 88 points or so, 88, 89 points. 89 to 490 is 579 is the target on QQQ. It's almost there. It touched 557, 579. You're talking about 22 points or $22 on QQQ to climb to get to that ascending triangle pattern. So the question is, are we going to get that bullish momentum, not get a right shoulder pullback, and continue climb towards that 579 on QQQ and the 6565 on the S&P? That's what the bulls are going to look for. The bears who are missing out from a FOMO would love to, for a pullback, get a right shoulder pullback and then enter at that test of the rising 50 to 200 day moving average on S&P, and a similar way on QQQ towards the 501 to 515 level, and from there mount a bullish climb towards a higher high. So we shall see what ends up happening. To sum it up, the key is the Treasury market is indicating breaking out of a falling wedge, indicating there is concerns of U.S. debt mounting from the big beautiful bill, deficit spending, and so on. 10-year yield broke from it. If this goes and breaks test 4.5, from 4.5 goes to 4.8, and then breaks 4.8 to 6%, that would be bearish on the market. That's what we watch on the 10-year yield. The 1-month Treasury did have a 25 basis point cut priced in and then gave it all back in late June into early July, expecting Powell to be very, very hawkish on the FOMC meeting on July 30th. So far, on non-farm payroll data has not given him any reason to be dovish or reason for him to price a cut. So that could be, unfortunately, the situation. And then VIX is, from the bear's perspective, giving a nice fodder that perhaps VIX could have a climb because of its positive divergence. Lower lows in VIX with higher lows in RSI and MACD means if VIX has a climb, you could expect that to time with the market pullback. The bulls, on the other hand, would say, well, look at the breadth on the summation index has got more upside from 800 to 1100. Maybe until it gets to 1100, the market has got more upside. And maybe that's what times with the Bitcoin breaking up from its beautiful cup here from 110 to 98 up to 110, go towards the 123 level, so 123,000 on Bitcoin. That said, a bigger term cup and handle on Bitcoin, of course, is a lot higher. If you take 74 to 112, that right there is closer towards almost 74 to 112, you're talking about 38 points. 38,000 to 112,000 is almost 150,000. That's where Bitcoin's upside is on its bigger cup and handle. But on the shorter term cup and handle from 110 to 93 to 110, we could watch that. That could easily take it to 123. Palantir, I would be extremely cautious, those that are chasing this. If you do get that upside towards 184, there's a possibility. But right here, if you're buying it, put a stop loss below this 134 level, which is, or 127 below its rising 50-day moving average. Because if it breaks that, it could easily come from 130 to 148. That's roughly $18. Subtract 130, 112 is where it could come down to. So I would be cautious on that, put a stop loss. But otherwise, if you want to climb it higher rise, potentially Palantir is headed to 184. But from there, from this negative divergence, see it topping out. NVIDIA, the target is beautifully towards 200. Near-term negative divergence could mean a pullback, and a pullback towards 143 would be an excellent buying point from where I expect it to climb back to 200. Small caps, it is got a beautiful target towards 248. We've said that in the past. However, on its hourly chart near term has met its target. A pullback towards the 215, 216 would be a great entry point on IWM, the small cap ETF. S&P, a right shoulder would be the ideal entry for those that are missed out. That's pulling it back towards the 5800, and from there playing a reversal higher. Versus the bulls, if you are holding it and want to ride it higher, 65 would be a great target for it to have a continued climb towards. QQQ, finally, the NASDAQ 100, if you do get a right shoulder pullback to the low 500s, would be an excellent entry to break out higher. Versus if the continued momentum is there from 556 to 579, another 22 points or 23 points on QQQ would be great for the bulls to ride it higher towards. With that, good luck investing. We'll talk to you next week. Thank you.